The US CPI data for December came in slightly below expectation, but however, the resulting impact was a kind of a muted reaction on the global markets. The FX market, the US dollar weakened on the release of the CPI data that came in weaker than expected for the US economy, but however, it whipsawed throughout the US session, and where the US dollar managed to close slightly higher, led by weakness in the Japanese yen. Overall, there is some profit-taking activities that were seen in the major US stock indices, led by JP Morgan Investment Banking Division missing its revenue target. For gold, prices remains firm on rising geopolitical risk premium coming up from the Middle East due to the Iranian crisis, where Trump tweeted yesterday that there could be some form of action being taken by the US White House administration. That being said, the rising geopolitical risk tension in the Middle East region risks cutting off global oil supply that actually sent WTI crude oil to a 12-week high. Very good morning to all. I'm Kelvin here. Welcome to today's special edition of the Daily Dose, where I'll be conducting our welcome bonus draw towards the end of the session. So before we kickstart the gist of the Daily Dose for today, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so this, which I've highlighted at the start of the Daily Dose, which is a special edition for today. So we'll be conducting our second round of welcome bonus draw, where towards the end of the Daily Dose, I'll be drawing out 5 lucky winners with a chance to win $888 credited to your trading account. So do stay tuned until the end of today's Daily Dose, which I'll be conducting the draw live. All right, so as usual, before we jump straight into today's full suite of the Daily Dose, which covers the entire spectrum of all the intraday technical outlook setup on the broad-based cross-asset classes that we cover on a daily basis. Let's have a quick look what has taken shape yesterday and as well as in today's early Asia session in terms of the relevant news flow, economic data releases, and as well as their respective impact on the cross-asset movement on the intraday basis. So let's start with the release of the key US CPI data for December that was yesterday over here. So very quickly, let me expand my screen. Okay, good. So let's take a look at the economic data, all right, that was released yesterday, US CPI data. So the US CPI data for both the core inflation on a month-on-month basis and a year-on-year basis over here came in below expectation. So for month-on-month basis, market is expecting 0.3%. It came in at 0.2%. And for the annualized basis, year-on-year, it came in at 2.6% on par with the November print of 2.6% as well, and slightly below expectation of 2.7%. So the initial reaction over here on the markets, if you will look at the FX market over here, right? So this is the 5-day rolling performance of the US dollar against other major currency as we are speaking right now on 14th of January over here. So what I could see over here is that, let me expand my screen. Yeah, good. So what you could see over here and on the cursor over here is that at this point in time, in this instance, where we see a dip down in the US dollar, all right, there's a dip down in the US dollar over here before the dollar weakness, intraday weakness got eradicated as the US session gets underway yesterday. So what you could see over here is that yesterday's release of the US CPI data, despite it came down below expectation, and from a fundamental perspective, it should be negative on the dollar, but the dollar didn't trade as much negatively as intended. So one of the reasons is causing the dollar whipsaw around the release and after the ex-post release of the core US CPI data potentially could be due to rising geopolitical risk tension in the Middle East, especially coming out from Iran, where right now the US may start to intervene in the Iranian protests over here. So what you could see over here is that yesterday Trump tweeted urging more Iranians to actually keep up with the protests amid this violent crackdown by their local authorities. So that create a rising geopolitical risk premium in the Middle East region, because we know that Iran is a strategic key player in the Middle East region. Anything that is erratically coming out from Iran, especially a regime change where US gets involved by sending in military action towards this situation over here, that could cascade into geopolitical hotbed in the Middle East region. So and that could potentially involve Israel as well, and some from the Arabic nations like Saudi Arabia. So that causes the safe haven instrument to get bidded. So which is i.e. A demand for US Treasury. Being a demand for US Treasury over here, we potentially see a firmer US dollar. So that causes the whipsaw in the US dollar movement yesterday. So what's startlingly important over here, I'll share you, is this K-shaped performance in the FX market, where we start to see the dollar is being traded against the strongest against the Japanese yen. So this is called a K-shaped performance, where you see the upper king, the dollar yen, leading the pack against the rest of the other dollar major currency that is kind of trading sideways. So what's the reason that causes the dollar yen to move up? Will be number one, speculators coming in after the break of that 15880 medium-term resistance level, which I highlighted yesterday, and also due to the fact that there could be an increased chance of local Japanese lower house snap election that's being called by the current prime minister as soon as February next month. So given said that she wants to solidify her current popularity ratings that's rising very high. So if she managed to gain a much more we call it significant winnings of seats in the lower house of parliament this time around, she could also potentially, or the current leadership could continue to push out much more aggressive expansionary policy. And that being said, that could also potentially influence the Bank of Japan decision-making process in some way or not, some way or another, because given the fact that the Bank of Japan at this moment in time is still in the mode of gradually increasing interest rates. All right, so if the current leadership has a stronger platform to call out for more expansionary policy in the Japanese economy, that could potentially hinder Bank of Japan operations. All right, so that actually being read by the FX market, thus pushing the Bank of Japan, pushing the dollar yen up to a close to more than a 1 year, slightly more than a year high right now. So later I'll share with you what are the key levels to watch, and bear in mind that the Japanese authorities are now watching very closely the ongoing steep weakness of the yen that's being expressed by the view of the Japanese finance minister, and as well as being echoed similarly by the US Treasury Secretary. All right, something to be mindful of as well. All right, so just to keep a watch, I think everything is good. Hopefully, in terms of the charts itself. All right, I think there's some a bit of lagging at the start of it. All right, so nevertheless, let us get underway. All right, and also now for the state of the US stock market. All right, so for the state of US stock market, yesterday we do see a series of profit taking across the board, where the SPX 500 is down by negative 0.19%, almost on par on the Nasdaq 100 that is down by negative 0.18%. And the worst hit was the Dow Jones Industrial Average, down by negative 0.8%, and the Russell 2000 almost kind of being the top performer among the sea of red, down only marginally negative 0.1%. So what causes the Dow Jones Industrial Average to underperform? Despite that sell-off in the Dow Jones Industrial Average, it still remains above our pivotal support on the US Wall Street 30 CFD index. Later I'll share with you guys in a couple of minutes time. So the Dow Jones Industrial Average is being dragged down by the key financial stocks, JP Morgan, and creating a negative feedback loop into the entire financial sector. And we know that the financial stocks, both of them, Goldman Sachs and as well as JP Morgan, Goldman Sachs being the top price weighted component stock in the Dow Jones Industrial Average, and the JP Morgan is being the top 5 or top 7 of the component stocks within the Dow Jones Industrial Average, thereby creating a negative feedback loop in the Dow Jones Industrial Average yesterday. So the reason why the financials underperformed, it was because JP Morgan, one of its key revenue, we call it a driver in traditionally for the past 3 to 4 years, which is the investment banking segment. Its fees actually drop on underwriting miss over here, so less in the form of IPO also. So the fees fall in the fourth quarter, missing the firm's own guidance from last month as revenue from underwriting and advising on mergers and acquisition decline. So, but however, JP Morgan give a kind of a rosy, we call it rosy affirming revenue guidance, saying that you expect to earn, okay, let me put it in bigger form, right? Okay, so that you guys could see. So you expect to earn about 103 billion in net interest income this year, this financial year, more than analysts expected. And its CEO, Jamie Dimon, said that the US economy has remained resilient. So some form of comforting words coming up from the management itself. But however, there's another negative driver that override this comforting revenue guidance from the JP Morgan management is due to the fact that Trump rhetoric on this credit card, we call it business for the banks in the US. So Trump himself wanted the credit card, we call it interest rates that's being charged to customer, which is at 20% now over here. And he demand to cap these credit cards, we call it interest rates to be be lowered to 10%, all right, interest rate cap over here. And he set a 20th of January deadline, which is next Tuesday, for compliance over here. So given the state that over here with this kind of rhetoric, and we know that credit card interest fee is one of the revenue driver for US banks / financial institutions that issue their own respective credit cards, that also kind of created a negative feedback loop into the share price of the US financials. So that actually explained to us the catalyst for causing the Dow Jones Industrial Average to underperform yesterday. All right, and one particular data I'll share you guys over here is that China, we know that China, there has been a talk about in the media about this deflationary risk spiral coming back into the picture again. But however, this deflationary risk spiral today is taking the backseat. Why? Because right now we see a very, very strong, we call it economic data release coming out from the balance of trade for December. So we know that China has been exporting pretty much significantly in the last 11 months or so. So for the month of December, export growth continues to grow very strongly, 6.6% year on year. That beat expectation of 3%, almost doubled, and above 5.9% year on year. That was in the month of November. So despite that geopolitical risk tension that is still at play in between the US and China, China has managed to export much more goods away from the US. All right, and what's interesting over here is that we're talking about imports. Imports also improved significantly for December. So why imports is important? Because we know that imports is actually representing purchasing power or the confidence of China consumers that are able to actually purchase more from the rest of the world. So imports being growing a much more significant higher amount, 5.7% year on year from 0.9% year on year. That was what market is expecting, and also surpassing the previous November print of 1.9%. So if you look at the growth of the imports over here, it has started to improve in the last 2 or 3 months or so. So inputs for December accelerated to 1.9%. So this is beating market expectation of 0.9%, and this marks the 7th consecutive month of increase in purchases and the fastest pace since June. So if you look at the 5-year trend over here, it seems that since the second half of last year, imports growth for China has been in the positive territory. It means that consumer and businesses are not getting more confident to purchase more goods from the rest of the world, thereby reducing the deflationary risk spiral in the Chinese economy. So that being said, we start to see a positive feedback loop in the China stock market today that came in within our expectation. So still recall that Hang Seng, we do have a bullish bias since the start of this year. So Hang Seng, since the start of the year, I would say up 0.7372%. The higher beta Hang Seng Tech Index, which comprises of the Chinese big cap technology stock listed on Hong Kong Exchange, up 1.16% over here. And the mainland CSI 300 index is up by a much more higher magnitude, 0.9%. The China A50 mainland benchmark index, which comprises of only 50 big component stocks, a smaller segment, up 0.5%. And that being said, that also created a positive feedback loop into the rest of the other Asia markets over here, given the fact that we do not see the other Asia Pacific market taking a much drastic hit from the negative performance that's been seen on the US session yesterday, where the Kospi is closed almost unchanged. The Taiwan capitalization weighted stock index, which is the benchmark, up 0.53%. The STI, a bit of profit taking, down by negative 0.15% as we're speaking right now, and also a bit of profit taking on the ASX 200, down by negative 0.2% over here. All right. And that sum up the first segment of the daily dose. So now let me move on to the second segment, which is much more interesting, which covers the intraday technical outlook on all the broad-based cross asset classes. So before we go, before I jump into the second segment, let me expand my screen over here. All right, so that you guys have a better view of the charts. Yeah. So let's start with the FX market first. So hopefully the chart is good. Yeah. All right. So let's start with the FX markets, which is the European currency against the dollar, which is the euro dollar. So the euro dollar continues to find some support at this short term. Okay, let me expand it. At this short term pivotal support area that we highlighted in the start of the week over here. All right, 116.40, 116.16. over here at this point in time. So what we could see is that prices now it starts to bounce off from this pivotal support level. So we still got to watch this pivotal support area very closely. 116.40, 116.60 to maintain our ongoing minor bullish reversal scenario after we start to see a minor corrective taking shape since the Christmas break last year all the way down to last Friday intraday low. So two key resistance levels to watch out for today on a very short-term intraday basis will be yesterday's US session high that is being seen on the ex-post release of the core US CPI data, which is at 116.78 over here. A breakout above 116.78 will potentially open up scope to retest this all-important upside trigger level at 117 figure. So why 117 figure level is very important? Firstly, is the swing high that is being seen on Monday. It can't break through and did this intraday, we call it pullback that is being seen on Monday and yesterday's US session, extending into yesterday's US session. So and also 117 figure level is the minor descending trend line that has been capping previous rebound over here since the Christmas Eve high of 24th of December that kickstarted this minor corrective decline. So if we start to see a clear bullish breakout, if we hourly close above 117 figure level, therefore the odds has been increased for the start of a new bullish impulsive up move for the euro dollar going forward. All right, so this 117 figure level is very important to watch. All right. However, a breakdown below 116.16 that will invalidate the minor bullish reversal scenario on the euro dollar and see a deeper minor corrective decline sequence unfolding, exposing the next support level at 115.90, which is coming very close to the 200-day moving average. A breakdown below 115.90 will see a further weakness towards 155.50, which is the minor swing low area of 26th of November. Previously, the former minor swing high of 21st of November and 24th of November that got broken up and retested on the 26th of November before kicking start the prior impulsive upmove sequence all the way until 24th of December last year. Right, so that's for the euro dollar. Next up will be the sterling pound over here. So the sterling pound also starts to see a recovery as well over here. So this recovery starts to take shape as we are speaking during the Asia session. All right, give me a minute, let me delete it. And right exactly at our pivotal support that we highlighted previously on Monday at 134 figures / 133.85. So and that also corresponds to the key 200-day moving average as well. So that being said, still maintain that bullish bias for this ongoing minor bullish reversal scenario to play out. So key resistance level to watch will be 134.90, like an upside trigger level, and this level was rejected after the release of the core US CPI data earlier, where the bulls can maintain their momentum and starts to see a intraday sell-off. So a breakout above 134.90 with an hourly close above it will increase the odds of this minor bullish reversal, translating into the a new impulsive bullish movement on the sterling dollar, potentially to seek out the next intermediate resistance zone of 135.50, 135.80, which correspond to this upper limit of the upper limit of this minor ascending or medium-term ascending channel, or minor ascending channel, pardon me, that / medium-term ascending channel that I drew from the low of 5th of November, and as well as coming very close to that 6th of January minor swing high area as well. Only a bearish breakdown below 133.85 that would invalidate today's minor bullish reversal scenario on the sterling dollar to see a extension of this minor corrective decline sequence, exposing the next near-term support level at 133.50, followed by 133.20, which correspond to the rising 50-day moving average. Okay, that's for the sterling dollar. Next up will be the Asia Pacific currency, starting with the Australia dollar as well. So the Aussie dollar also managed to bounce off exactly at our pivotal support zone that we highlighted, but can't break out above our upside trigger level, which is 67.20 that we mentioned earlier on Monday, and as well as yesterday, which is being featured as our chart of the day. So these are the very two important technical levels to take note of. So what you could see over here is that we start to see another higher low that's being formed right exactly at the 20-day moving average that has been providing a good near-term support level since 18th of December. Every time we hit close to it, it bounces, hit again on 31st of November, hit again on 5th of January before shaping that important retest of the 11th October 2024 high at 67.70. So all in all, we still respect the current positive movement on the Aussie dollar, given that that said, predefined short-term pivotal support still remains intact, and with the positive reaction that we are seeing right now in today's Asia session on the Aussie dollar, we will still continue to maintain that potential minor bullish reversal scenario using 66.70 for shares / 66.60 as my short-term pivotal support zone. Clear key upside trigger level will be at 67.20. So we got to have a clear bullish breakout and hourly close above 67.20 to increase the odds of this minor potential bullish reversal scenario to play out fully, to at least in the first step retest 67.60 for today. So that will be the 11th October 2024 swing high that got rejected on 7th of January, which was last Wednesday. However, a bearish breakdown with an hourly close below 600, that's below 66.60 short-term pivotal support zone lower limit that will invalidate the minor bullish reversal scenario and see the extension of this minor corrective decline extending further towards 66.30, maximum 65.90, which is confluencing with the rising 50-day moving average as well. So that's for the Aussie dollar. Lastly will be the dollar yen. So before I touch on the dollar yen, let me actually share with you on a longer time frame chart. So it clearly broke above this key resistance level at 58.80 / 35. And right now we are now floating into a very important zone. So this zone over here is where previously Bank of Japan intervened, 26th of April 2024 at around the 160.23 level, and 12th of July 2024 at around the 159.45 level. All right, and maximum will be, this is the pivotal resistance 161.95, where it starts to break down and trade in this kind of sideways range configuration. All right, so momentum still remains strong so far, but we got to be mindful that anything could happen, especially given that we know that next Monday is a US holiday, and US is being one of the key major financial center. With the closure of one key financial center, there will be less liquidity in the FX market. And in order for a potential intervention to take shape, very likely the Japanese authorities may use this thinner trading environment to evoke a much more we call it forceful after effect of the intervention to be much more successful due to a lack of liquidity, where a price action could move more violently as intended by this potential intervention that the Japanese authorities may undertake. Right. So with that, let us now look at the hourly chart of the Japanese dollar yen over here. So yesterday, price action broke above the 150.80 level, all right, very clearly. And during the US session, it did a retest before shaping a series of higher high escalation. So this 149.45 was previously it's where the BOJ under the instruction of Ministry of Finance intervened in the FX market, where they actually brought the yen and sold the dollar, and right now it's also confluence with a Fibo extension level at 149.75. So with that being said, I have a pivotal support level for today, 158.15. I don't want to put it so tight at 158.80 just in case of any whipsaw. So 158.15 very clearly was a kind of a minor range stop that the dollar yen struggled on last Friday and as well as on Monday US session before breaking out yesterday. So as long as managed any minor pullback that managed to hold above 15.15, I will still have a very cautious intraday bullish bias. Why cautious? Because it's now approaching into an intervention zone. First resistance level will be 159.45/75. Above it potentially exposes 160.25, 160.35, which is the 5th and 8th of July 2024 former minor swing low, and as well as the 1.382 Fibo extension taken from the ongoing rebound that's being seen on 16th of December, and as well as the upper limit of this minor ascending channel drawn from the low of 16th of December as well, very close to this area. Only a bearish breakdown below 158.15 and the hourly close below it will kickstart a minor corrective pullback scenario or sequence in the first step, exposing the next near-term support level, 157.50, 157.28, 157 figure level, which correspond to the rising 20-day moving average, and as well as the lower limit of this ongoing minor ascending channel drawn from the low of 16th of December, right? So I think all is good on the chart in terms of the visualization, right? So that sum up the intraday technical outlook on the FX market, all right? So now let's move on to the intraday technical outlook on the global stock indices, starting with the Asia Pacific, which is the Hong Kong 33 representing the Hang Seng Index. So Hong Kong 33 continued to bounce as expected, hitting our first resistance level previously at 27,175 before shaping a pullback yesterday. And this pullback was rather healthy, where the hourly RSI is also managed to stage a rebound from a parallel ascending trend line. All right. So with this over here, we continue to maintain our bullish bias on the Hong Kong 33, represent the Hang Seng Index, using a tightened short-term pivotal support level at 25,590, very, very close to yesterday's Asia session swing low and US session swing low at this 26,730. So using case, pardon me, is a typo error over here. It should be 26,590. Okay, I repeat again, using 26,590 as my short-term pivotal support level, a tightened one on the Hong Kong 33 that is representing the Hang Seng Index. We will still maintain that intraday bullish bias above 27,175, potentially seek out a retest at 27,500, which is a major resistance on the Hong Kong 33. Why 27,500 is a major resistance? Let me take you through the weekly chart on the Hong Kong 33 CFD index. So 27,500, pardon me. Firstly, it got tested earlier on 29th of September before it did that bullish consolidation above the rising 200-day moving average, and 27,500 is also the major long-term circular descending trend line linking from the current all-time high that was printed way back in 29th of January 2018 at 33,495, previously kept significant rebound in check February 2021 exposed COVID period, and thereafter we see the Hong Kong 33 trading downwards in a major downtrend due to that differentiating risk spiral. So with a clear breakout of 27,500, a weekly close above it will indicate that the Hong Kong 33 now has transformed into a major uptrending phase that could potentially last for a multi-month perspective. So something to look out for on the as it approaches this key major resistance level at 27,500 on the Hong Kong 33. All right, so that's the intraday technical outlook on the Hong Kong 33. Let us now proceed with the Japan 225, which is the Nikkei 225. So like I mentioned earlier on, the Nikkei 225 continues to be in a bullish upbeat mood despite rising JGB yields, where some critics say that it will collapse the Japanese economy. But the momentum of the stock market continues to remain rather firm. So price action on the Nikkei 225 burst up above our short-term pivotal resistance yesterday, where initially yesterday we attempted to actually have a very short-term intraday bearish bias for a minor corrective pullback. So this minor corrective pullback is indeed take shape, but it only lasted until 2 p.m. Singapore time yesterday, where it printed a low of 53,479, almost hitting our first support level at 53,370 before shaping a bounce of a higher low. And in today's Asia session, breaking above that pivotal short-term pivotal support that we have yesterday at 54,110. So with this bullish continuation of a movement, thereby can't break below our first support of 53,370, the chances for it to shaping a deeper minor corrective decline to retest 52,830, 52,644 is now been greatly reduced, and very likely we now continue to see the bullish impulsive upward sequence resuming in the Japan 225 CFD index representing the Nikkei 225. So with that, for sure, I'll be using 53,370 as my key short-term pivotal support for today. Intermediate support for any potential minor pullback will be at 54,110. As long as this minor pullback is surpassed below 53,370 short-term pivotal support for today, we will have a bullish bias on the Japan 225. Next resistance level to watch after 54,565 will be 54,910, 55,050 next, followed by 55,530, 55,623, comprising this we call it Fibo extension cluster level, and as well as a much more steepened minor ascending channel that has taken shape after yesterday's strong bounce into today's Asia session as well. And that also corresponds to the upper limit of this steepened minor ascending channel, which is the 55,530, 55,623 Fibo extension cluster levels, right? Only a bearish breakdown below 53,370 with an hourly close below it that would invalidate the bullish impulsive upward sequence for today on the Japan 225 and revisit that minor corrective decline scenario taking shape again, exposing the next near-term support level at 52,830, 52,644, maximum 52,060, which confluence with the lower limit of the form of the another minor ascending channel drawn from the low of 18th of December last year. So that's for the Japan 225. Next up will be the Germany 30 that is representing the German DAX. So the Germany 30 continues to churn with a series of higher high and higher low, all right, over here. So very strongly it continues to churn upwards, all right, with a support level to take note of will be at yesterday's European session low at 25,373, and also the upper limit of this upper boundary of this former medium term ascending channel drawn from the low of 21st of November that got broken up on last Friday and now turns into a near-term key pullback support level at 25,373. So still no change, still using our pivotal support level at 25,200 to maintain this ongoing bullish biasness in the Germany 30. I repeat again, pardon me about tongue twisting. So still maintain our bullish bias on the Germany 30, representing the German DAX, using 25,200 as a short-term pivotal support level. Next resistance level to watch will be a bunch of Fibo extension cluster level, 25,800, followed by 26,030. Only a bearish breakdown below 25,200 will invalidate this direct push-up scenario to kickstart another round of minor corrective decline sequence within its minor uptrend phase that is still intact, exposing the next two near-term support level at 25,065, followed by 24,860. Right, so that's for the Germany 30. Onward, next will be the major US stock indices, starting with the US Wall Street 30, representing the Dow Jones Industrial Average. So the Dow Jones Industrial Average yesterday during the intraday session, it attempted to break out above the current all-time high area at 49,606, come broke above it and staged that minor intraday sell-off. But once interestingly, this minor intraday sell-off managed to pause at the lower limit of our pivotal support zone, which is 49,096, and with the hourly RSI hitting the oversold level and is now attempting to exit from the oversold level as well, indicating that some form of easing of downside momentum that's being seen in the US session overnight. So still no change, still using the pivotal support zone of 49,250 / 49,096 to the lower limit of 49,096 to maintain our bullish bias on the US Wall Street 30 CFD index. A clear breakout above 49,606 with an hourly close above it will potentially seek out another form of higher high to visit the next intermediate resistance zone at 49,805, 49,840 for today. So that's actually a Fibo extension cluster level, and as well as the upper limit of this medium-term ascending channel taken from the low of 23rd of May 2025 low. Only a bearish breakdown below 49,096 with an hourly close below it will expose the US Wall Street 30 for a mean reversion decline on the minor scale to revisit 48,870, 48,770, which correspond to the minor bullish reversal swing low of 8th of January and also the rising 20-day moving average. A breakdown below 48,770 will see a steeper minor corrective decline sequence unfolding, exposing the next near-term support level at 48,480. All right, so that's for the US Wall Street 30. Next up will be the S&P 500. So S&P 500 continues to shape a bounce as expected. So the bounce hit our first resistance level yesterday after the release of that core CPI data, which is 7,705 before shaping that minor pullback over here. So no change in terms of pivotal support. So pivotal support will remain the same at 6,925, which correspond very closely with the rising medium-term ascending channel support from the low of 21st of November. All right. First resistance level to watch will be yesterday's intraday high at 7,000 / 7,005. Clearance above 7,005 will expose the next intermediate resistance at 7,380, 7,045. Only a bearish breakdown below 6,925 and hourly close below it will negate this bullish tone and see a continuation of this minor corrective decline unfolding to retest the rising 20-day moving average that's converging with the next graphical near-term support zone of 6,900, 6,890. That's for the SPX 500. Next up will be the Nasdaq 100. So Nasdaq 100 continues to float around this stubborn 8 to 12 of December 2000 range top that kept the bulls in check since 8th of December last year, which is at 25,830. So no change unless you're able to have a very strong clearance above 25,830, then I will tighten my pivotal support level to 25,600. Okay, so for now, pivotal support still remains the same between the 20-day moving average and the 50-day moving average at the zone of 25,450, 25,350 for today to maintain that bullish bias. Next resistance level to look out for on the Nasdaq 100 will be at 26,107, which is a Fibo extension cluster level. However, a breakdown below 25,350 and hourly close below it, then we will see another round of choppy minor corrective decline sequence unfolding, retesting the 2nd of January minor swing low at 25,133, maximum 24,870 next. So that's for the Nasdaq 100. And also sum up all the intraday technical outlook on the major stock indices. Let us now proceed with the commodities market, starting with gold XAU / USD. So gold XAU / continues to trade firmly, holding above our first support level at the 4,550, 4,560, former all-time swing high. So given that it haven't cleared above our first resistance level of 4,645 that we highlighted previously, I do not want to tighten my pivotal support to be so tight at 4,450 / 4,560 unless we have hourly close above it at 4,645. So for now, pivotal support will still remains the same at this gap up support level that was seen on the Monday of 12th of January, 4,512, to maintain that ongoing bullish biasness. above 4,645 exposes the next two intermediate resistance level at 4,684, 4,687, followed by 4,720, which is the Fibo extension cluster level. Only a bearish breakdown below 4,512 and the hourly close below this level will invalidate this direct bullish bias move on the Gold XAU/USD and see a start of another minor corrective decline sequence, retesting the rising 20-day moving average that's confluencing with this next intermediate support zone at 4,430, 4,403. So that's for Gold XAU/USD. Next up will be the very interesting West Texas crude oil. So West Texas crude oil squeezed up above our neutrality zone where we turned neutral previously, hitting our next resistance level at 61.17, 61.35, which is the swing high area over here of 12th of November. And what we could see right now is a bearish divergence that has been formed very clearly, 3 lower high at the overbought level. And right now, if it exited from the overbought level, indicating that the strong push-up since Monday, 3 days of push-up, is now losing upside momentum. So with this negative reading that's being seen on the hourly RSI, we will flip to an intraday bearish bias for today on West Texas oil using 61.17, 61.35.35 as my short-term pivotal resistance zone. First two support level to watch will be $60 per barrel for West Texas oil. A breakdown below 60 will see a retest at 58.75, which is right now the 50-day moving average, acting as a pullback support level. And also this former descending trendline resistance now turns into a pullback support that previously survived on Monday as well during the European session, all confluencing at 58.76. Only a breakdown below 58.76 will potentially unleash a further weakness back down towards the range zone, the lower level of the range zone, exposing the next support level at 57.74 in the next step, which corresponds with the 20-day moving average. However, a clearance above 61.35 will continue to see this corrective rebound squeezing up towards the upside, heading up towards potentially the 200-day moving average, which I think confluences with the next resistance zone of 62.45/63 figure level, which is the swing high area of 8th of October and 24th of October last year. So that's West Texas crude oil. So that sum up the all the intraday technical outlook for today on the broad-based cost asset classes. So before we go, before we start the draw, the special draw for today, the welcome bonus draw, let's have a quick look at the economic calendar. What are the key data to look out for today? So during the European session, we will have key European as well UK bank, central bank officials speaking that could sway the movement of the euro dollar, the euro crosses, the sterling dollar, and the sterling crosses. Will be Bank of England Taylor's speech, public speech at 4 p.m. Singapore time, and followed by 4:20 p.m. Singapore time, ECB Gondio's speech. Then thereafter, we will have a second tier US CPI data release, more pertaining to the inflationary start of the story, which will be focusing on factory prices. We will have the purchasing producer index release for the month of November. So PPI for November, market is expecting us consensus to be at 0.3% year on year. Then thereafter, we have the same time, 9:30 p.m., we have the retail sales figure coming in as well for the month of November coming into the picture. So that could potentially influence the major US stock indices and as well as the major US dollar pair. And as we head into the US session, we have one Fed official speaking, Fed Paulson, at 10:50 p.m. Singapore time, and followed by 11 p.m. Singapore time, Fed Miran. But I think Fed Miran should be as dovish as possible, given the fact that he's part of the Trump administration previously over here. Then with that, we will go into the US session rather quiet, and heading into the early part of tomorrow Asia session at 1 a.m. Singapore time, early Thursday. We have two Federal Reserve officials speaking, Fed Kagaski, and at 3:10 a.m. Fed Williams speech. All right, and we head into the early Asia session tomorrow. Will be a rather quiet session before the start of our daily dose at 11 a.m. And not forgetting right now, today will be also a very important day in terms of US stock market, as we continue to see 3 major banks releasing their results today before the start of the US session, likely between 8 p.m. Singapore time to 9 p.m. Singapore time. We have 3 major US banks releasing their result. on Wednesday, 14th of January, before the start of the US session, around 8 p.m. to 9 p.m. Singapore time, Bank of America, Citigroup, and Wells Fargo. So these banks being said that they have a higher significant weightage in the, I would say that the financial sector has a higher significant weightage in the Dow Jones Industrial Average. Therefore, they could influence the US Wall Street CFD index much more significantly, and in some form, the S&P 500, for the Nasdaq 100, a much more lesser magnitude. So something to take note of for today as well over here. All right. So with that, now let us now proceed to the much exciting segment that we have for today, which is the welcome bonus draw. So we'll be starting pretty soon the draw right now live. So let me expand my screen over here so that you guys could have a better view of the charts or better view of the draw that I'll be drawing. Okay, let me set the draw. All right, so I think you guys have a better view of the charts, the draw right now, as you could see the draw. All right, so right now, let us proceed with the draw, and I will kickstart. So we'll be drawing 5 lucky winners over here. So I think everything is good. 5 lucky winners. So let us get kickstart with the first winner. So who will the first winner be? All right, we have the first winner. So congratulations to user ID F7032EE over here. And we'll be informing you via email pretty soon on your price, which is the $888 credit into your trading account. So let us now draw the second winner. All right, so we have a second winner. So congratulations to user ID 6CA459A1 over here. All right, big congratulations to you. Let us now proceed with the draw for the third winner. All right, I think we have the third winner. Okay, congratulations to user ID D019E405. Big congratulations. Now let us draw the fourth winner. All right, we have the fourth winner. Big congratulations to user ID F2CE8A4D. Big congratulations. So we have one more winner. So they will be the fifth winner over here. So let's see, who will it be? All right, a big congrats to user ID 26433D77. All right, so very big congratulations to all our 5 lucky winners. You guys will be receiving 888 trading credits into your trading account respectively, and all winners will be notified by email 7 days from today. And last but not least, do not forget, for those who didn't manage to actually win in this welcome bonus draw, we still have one more last draw to go, which will be held on the 16th of February. So do take note of that. So with that, that ends today's session of a Daily Dose of Market Insights. I'm Kelvin here, signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.